Great. Hello and welcome to the GRadulting Workshop Series. My name is Debbie McCutsky. I am the coordinator of services and programs for graduate student legal aid, and I use she, her pronouns. Simone Durham, one of our grad student advocates on our staff, is here as well, and she's going to help ensure that things go smoothly today. So we're happy to see you here on Zoom and on YouTube because we are going to help you prepare your taxes. Yes, I know it's not fun, but I'm glad you're here because we can give you some guidance and answer some of your questions. So before we talk taxes, I want to tell you a little bit about legal aid because we do much more than this GRadulting Workshop Series. We handle legal issues, immigration issues. We help students who get charged by the Office of Student Conduct. And I'm a notary, so I can help you with that. So if you paid your graduate student fee, then you've paid for our services. There's no additional charge. So let us know when you need our help. Visit our website to learn more about our services. There you'll find instructions for how to request an appointment. And also I suggest you sign up for our weekly briefing. That'll give you a reminder about the upcoming workshop, information about our services, and a bit of news. So just a little bit of housekeeping. Automatic closed captionings are enabled for those who want to read along. Near the end of the workshop, we'll share a link to a survey because we need to know how we're doing with these workshops. We will email links to the survey, the slides, and the recording this afternoon to everyone who registered. Those links will also be posted on our website, which is gradlegalaid.und.edu. Finally, we welcome your questions. This workshop, we hope it will be really interactive. So remember to use the Q&A feature, not the chat, the Q&A feature, and note that you can upvote a question that you like. It'll just move it to the top of the list for us. And hold your questions until the end of Sam's presentation, because he may answer your question in the course of what he talks about today. So let's move on. I am so pleased to welcome back and introduce our speaker, Professor Sam Handwerker. He is a CPA. He has his master's in taxation. He is a full-time lecturer in the Smith School of Business and an advisor for TurpTax. TurpTax is an amazing organization, and Sam has built it up to be a really great resource for students at the University of Maryland. I just want to also mention that TurpTax is funded by the graduate school, and we appreciate that support for this very important service. So without further ado, I will turn things over to Sam. Good to see you, Sam. Thanks for helping us out today.
My pleasure. Thank you very much for the warm introduction. And I'll just follow up by saying, which I'll say at the end as well, but the commercial for TurpTax would be, we are a free service. We offer free tax preparation for most individuals who are within, say, a couple years out of school or still grad school students. We also offer, I would say, tax education. We can't be giving out tax advice, but the education that we give out, if you have specific questions, can be addressed to you specifically and can be considered coming from a CPA, just not in the practice of a CPA. Okay, so that's that. So it's good. It's good. It's all free. And with that, I will go to share screen so we can take a look at what our agenda for the day will be. And here we are. So what we're going to do is we're going to first have me pontificate with a lot of information, introduction to tax, who has to file, who's a dependent, why does that matter, education credits, what that might mean for most grad students, a look at forms, planning tips, and then I'll shut up and we'll have a Q&A. So I'll answer any individual questions that you might have and hopefully answer yours that would apply even perhaps in the presentation. Okay, so there as we go, and away we go. I wanted to just give you a basic idea of what the income tax formula is, so that when you're filing your tax return, maybe for the first time, or you filed it before, but you didn't quite follow along the theory of tax, this is the basic theory. First, you have income from whatever source derived, as it says at the top. That means worldwide income. So for those of you who are grad students, but maybe international students, you need to know that you may not be a non-resident anymore if your visa status is transitioning from F1 or J1 after your first 5 years. If that applies to you, then you are going to be considered domestic, and you file just like all the other domestic students that might be tuning in today. And for all of us, US citizens or residents, for whatever reason we are residents here under the tax law, it's not your visa status, it's your status under the tax law. For all of us, this is the formula we file, which was income from worldwide, whatever source, whether it's in the United States or outside the United States, it all has to report it. There are certain exclusions from tax of income, so you get to subtract that or not report it, but you have to know what that is. There's a table the IRS gives out on table 2-2, and it tells you. Then you wind up with your gross income, which will be leading towards your taxable income. There are deductions for AGI, what we call adjusted gross income. So these deductions to derive adjusted gross income are allowed. They're specifically, as you see, there's a specific table for that. And all these tables will be provided for Debbie to disseminate after the seminar is over. After you get to adjusted gross income here, then you have other deductions. So they just got different levels of deductions. They're there for a reason. We don't have to get into it, but the definitions of AGI, adjusted gross income, is important. And then deductions from AGI to derive at what eventually will be taxable income. That's the key, because that's where the tax rate is applied. And the tax rate will depend on your level of income. We live in a progressive society of taxation. The greater your income goes, the higher the tax rate. And so if you are on the lower scale as you first start out, or as you're a grad student, your tax rate will be rather low, which is nice. Finally, after you come up with your gross tax, after applying the rate, you may have certain credits that will apply that reduce the tax, or prepayments, which we will also call withholding taxes. Most of you who may be working will be familiar with withholding taxes being taken out of your paycheck. They'll show up on your W-2 at the end of the year, and it'll show you what you have prepaid in tax, which will wind up giving you your net taxable income all the way, your net payable, I should say, all the way at the bottom. Everybody likes to get a refund when their tax return is done, but a refund doesn't necessarily mean you have a good tax preparer. It just means that you may have prepaid more than you needed to, and so now you're getting some of it back. All right, that's the basic formula. Now we get to filing tips for the college students, and particularly with the grad students in mind. Do you need to file a tax return? That's a good question. And the basic answer is it depends on your income and whether you had taxes withheld. So it's both. It's income level and whether you had taxes withheld. If you had taxes withheld, you probably want to file, because maybe they have withheld too much and you're going to get some of it back. And if they withheld too much, it's not necessarily the employer's fault that they might have withheld too much. It's just the way the tax tables work for the withholding taxes that employers follow. So if you have taxes withheld, even if you're not going to owe any taxes, you'll get all those back by filing your tax return. Then you get that refund. And that's a yay. Okay. If you're single and you're earned more than $12,550, you must file. You must file. Something less than $12,550, if you didn't have taxes withheld and that's all you earned, then you don't need to file, because your standard deduction, which we'll abbreviate as SD, your standard deduction, which was in that tax formula as deductions from AGI, if you were paying attention, okay, but the standard deduction for you is $12,550. So even if you wind up with adjusted gross income of $12,550 or less, your standard deduction will take care of wiping that out to zero, and you're not going to have any tax. But if you had taxes withheld, then you know you can get all that back. If you go over the $12,550, you must file. There it is, required to file. Over 12,550, required to file. What is the 12,550? It includes earned income from a job, unearned income from investments. And then there's a new caveat we're going to come across, which is that investments can include income from cryptocurrency trades. And cryptocurrency trades can simply be using cryptocurrency to buy things with. Oops, I didn't know that was a taxable event. Well, it most likely is if you use cryptocurrency to buy new cryptocurrency in a different currency exchange or to buy goods or services. That's a taxable event. And the first question on the tax return, the very first question they ask after they get your name and social security number is, did you deal with cryptocurrency during the year? And they're making that the first question because they want you to be aware of this slide right here. Investments income can include income from cryptocurrency trades. So enough said about that. You now are forewarned, forearmed. Watch out for that. Now, the new information that we didn't give you before, we said if your income was over 12,550, you must file, but you wouldn't have to file if it was below. That key number is still true, but there's another number, which is if your unearned income is greater than 1,100, then you still must file. So let's take an example here. Suppose you're earning $12,000 as W-2 wages. You're working for $12,000 a year. If you had no unearned income, which is interest, dividends, cryptocurrency trades, or gains on crypto, or gains on sales of stock, if you were less than 1,100 with all this, then you don't have to file as long as your earned income is less than 12,550. But once this number for all these types of unearned income, or what you might call passive income, once that goes above 1,100, regardless of whether you were working or not, regardless of whether you had with taxes withheld, you still have to file. So that's a real low threshold. Also, if you worked as an independent contractor, and many of you do or did, if you work as an independent contractor, you will have, and you will know if you did that because you will receive a form showing your income of 1099 NEC, which stands for non-employee compensation, hence independent contractor. Non-employee compensation, independent contractor. The W-2 is for wage earners. We'll take a look at these forms later, but for the moment, let's just get it out on the open. That self-employment income, you will know if it's greater than 400, that if it's reported on a 1099 NEC. So then if you have unemployment income, you must file as well. And it doesn't have to be much, as you can see. Now, there are deductions that can reduce the taxability of the self-employment income, but that's a different story. That's creating what would be a small business. And many independent contractor agreements, you don't have expenses. All right. The tables that we were talking about come from the tax information for students guides. If you're interested in that formula and those tables, still consider filing to receive refunds is again a warning that even if you're below the 12,550 or below the 1,100 or didn't have an independent contractor, if you had taxes withheld for any reason, file to get those back. All right. Some of you have a situation where your parents may still be claiming you as a dependent, and that can change the dynamics of your tax return a bit. So I want to just go through that quickly. Until age 19, meaning 18 and under, you are automatically considered a dependent of your parents or guardians. That's a default rule. Once you go to above 18, meaning age 19 and above, then it depends on whether you're a full-time student. If you're a full-time student, you're still a dependent up until age 24, meaning including age 23. So if you're above 23, you got nothing to worry about as far as the dependency goes, unless you're being supported and living at home. Let's say that one more time. If you're being supported, meaning more than half your support, and living at home with your parents or guardians, then even age 24 and above, you probably are dependent on those people who are supporting you, those nice people. And that means that your tax status is one of being where you check a box on your return that says you can be claimed as a dependent. So you would check the box that you are claimed as a dependent if you meet those basic rules. They are very complicated, but that's the basics. And so to round it off, if you are 23 or less, or age 24 or more and are living at home and you don't provide more than half your support, you're still a dependent of those people helping you with your support. Part-time students over 19 may not be a dependent, working and making more than $4,300, they are not a dependent. So part-time students over age 19, not full-time students, and the definition of full-time student is based on the university where you're at. So if Maryland considers you to be a part-time student based on your enrollment, that's the definition you're going to live by. In that case, if you are working and making more than $4,300, you're not a dependent, so you don't have to worry about those rules. You claim yourself. Not that that has any meaning today, but it does in terms of reducing taxation, but it has meaning in certain credits that you're eligible for. Okay, this is for our undergraduates, so we're going to skip this because the AOTC credit for college expenses really applies to the first 4 years. So I want to skip to what probably applies to most of you as grad students, and that would be the grad school credit, which is going to be called the lifetime learning credit. There you go. The lifetime learning credit, which is not as valuable as the American Opportunity Tax Credit for the first 4 years in school, but it should still not be ignored because it could be leading you to get a refund. Here's how the lifetime learning credit works. It doesn't matter whether you're part-time in school, full-time in school, half-time, whatever it is. It's if you spend money, your own money, not tuition remission, not scholarship, not fellowship, not money from a 529 plan, but if you spend your own money on tuition, so you're paying your own tuition, your cost of going to school, that is worth 20% of the eligible expenses, which tuition is, to get you a credit, meaning reduction of tax, up to $2,000 per person, up to $2,000 per person. So if you worked and you owe some tax and you paid for some tuition, if you paid $10,000 of tuition, you would be eligible for credit of having paid $2,000 of tax. So whatever your tax liability is, it will be reduced by that $2,000, perhaps to zero. You don't get a refundable amount. There's no refund that you get if you had no taxes to be paid, you don't have a tax liability, and you still had $10,000 of tuition expenses that you paid for yourself. You can't get that as a refundable amount. But if you do owe taxes, it will at least reduce dollar for dollar up to $2,000. Now, if your parents claim you as a dependent, they may be able to take that credit instead of you. So if it means nothing to you because you don't have taxable income, if the parents can claim you as a dependent based on the information that we went through as who's a dependent, then you can say to your parents, hey, here's my tuition that I paid for, or here's the tuition that you paid for, and guess what? It doesn't matter who pays for it. The parents could take it or you could take it, but the parents can only take it if they can claim you as a dependent. That's why we went through the basics of those rules. Both credits have income limits. This refers to the lifetime learning credit and the AOTC. So you'll need to see who gets to take the credit. If you still can be claimed as a dependent by your parents, you have to see if their income limits exceed the amount where they can take maybe no credit whatsoever. Maybe you were lucky and your income exceeded as well, because it's certainly a large amount. It's for single individual, it's over $90,000, where I think you phase out of both credits. For married couples, it's 180. So it depends. All right, now we're on to tax forms. What do you need? Oops, here's a break in the action. This is the way CPAs view our Internal Revenue Service and their crazy tax forms. Okay, for residents, which is most of you, you're going to file 1040. That's for a resident. Residency is determined by tax law, not visa status. If you're a citizen, you were born here, you're automatically a resident, you're automatically a 1040. If you have independent contractor status during the year, that's going to be a Schedule C for self-employment income. If you have a small business, that's Schedule C for self-employment income. And you'll have that attached to your 1040. The Schedule C allows you to both report the income you earned as an independent contractor, we'll call that IC, and to take deductions that you may have legitimately had in your endeavor as a independent contractor or self-employed individual. This is the famous W-2. Okay. And how do I know that? Because I'm going to write up at the top here, W-2. That's what it is. What you're looking for here when you go to examine this is you want to see if they've reported the right amount of taxable wages. That's box 1. Then real important is see what they did here. These are the withholding boxes. And we have one here, and one here, because the state is broken down into both state and local tax. There's a county tax and then the state tax. So in Maryland, you have both. And you're looking for numbers in these boxes. If you have numbers in these boxes, it's my advice, definitely file to find out if you can get a refund of any of those amounts. Then you also want to be clear of the fact that you have Social Security wages, Medicare wages, and there'll be taxes withheld for that. That's not refundable, unfortunately, but it does go to your credit for eventual retirement if there's a Social Security system when you retire here in the United States. Good luck, and no more comments about that. But that's what those boxes are about. And then if you had any kinds of benefits, you're going to see information about the benefits your employer gave you here with certain codes that are attached to the W-2 form. So you can find out what those numbers mean just by looking at the backside of the W-2. Now, just to anticipate one possible question is you may wind up having worked in more than one state. So in that case, you're either going to get more than one W-2 showing the various states that you worked in, or sometimes the employer will break down the states that you were working for. If it's the same employer, but in different states, they'll break it down into the two or more different states on the W-2. And if you worked in more than 2 states, you're going to need to definitely want to check about filing in those states to see what your filing requirements will be based on how long you were there and based on how much income you had there as reported per the W-2. All right, here's that famous 1099 NEC for the independent contractor. What you're looking for here is how much was reported to you as being paid for non-employment compensation. Again, if you get one of these, you need to file. There's no question about it. So one W-2 for $12,550 and less and no withholding, you could probably, if that's all you have, you probably don't need to file. But one of these, and you're going to need to file. Student loan interest. This is a new idea. Student loan interest. If you are already paying back your student loan, then you will get one of these forms from whomever you're paying it to, the recipient, and they will be telling you how much the lender received from you, not in total payments, but of the payments, how much was interest. They don't have to tell you how much was principal. They'll tell you how much they received in interest, because student loan interest is up to a point deductible on that return. In that formula we first looked at, it's deductible. So if you qualify, and you get to reduce your taxable income by the amount of student interest you paid. Again, subject to rules that your tax preparer software will ask you for, and you'll put that in. But don't forget to at least address the issue in case it's deductible for you. One other big point here is with this form, which is the 1098T. 1098T is the tuition statement. Many of you are familiar with this. You've been getting it. over the years when you pay tuition. Some of you get it where you pay tuition, but you're paying tuition through scholarship or fellowship or tuition remission, in which case the form will give you 2 points of important information. One, they'll give you the amount of tuition paid for the year. That's important. But then they'll also give you the amount of scholarships or grants that you received during the year to help pay for that tuition. Now, if you were to call, if I was going to do this as a credit course, I'd be asking you the quiz right now of the question of, do you remember what the first line item of the formula for taxation was? And you'd say, So what that first line was is tax from whatever source derived, income from whatever source derived. So now we come back to this doohickey form here, pardon the language, tuition statement, and see, do you have any income from whatever source derived that needs to be considered taxable? And here's the thing. Yes, you pay tuition, we'll call that X. You may have received Y amount of scholarships and grants. In the event that the Y, when you do X minus Y, comes out to be a positive number, it means that the scholarships and grants didn't cover all your expenses for tuition. You got scholarship, it helped, but your tuition might have been 10,000, that's the X. The Y might have been 5,000, that's the scholarship. So you were left with money that you had to pay out of pocket. If it's a positive number, then you want to check out that lifetime learning credit, because that means that you paid it, not some scholarship. Again, the lifetime learning credit is for what you pay if it comes from a 529 plan or from some other tax favored investment. It would not be something that you can take the credit for, but you want to make sure you're looking into that before you file your return. So if it's positive, you may indeed have a lifetime learning credit because it looks like you paid some tuition out of pocket. On the other hand, let's do the opposite. Suppose the Y is greater than the X. Well, since you're grad students, I don't have to tell you it'll be a negative number. So we'll just call it negative Z. Negative Z means that you received more scholarships and grants than your tuition requirement was. That means that you were personally benefiting from the scholarship and grants on the fact that you could have used the minus Z amount, the overpaid amount of scholarship and grants over your tuition. You could have used that negative Z in your pocket for room, board, entertainment, gasoline for the car. You could have used it personally, not for tuition, not for required fees of the school. And that is an accretion. Oh, that's a great word. That's an accretion. I'm probably spelling it wrong. That's an accretion of wealth because it's helping you with your personal expenditures. So the minus Z in this case is a possible indicator that your quote wealth has gone up, and that's considered income from, fill in the blank, you got it. I hear you, you're saying from whatever source derived, even scholarships and grants. So you need to be watching out for that. This is a complicated area. At TurpTax, we are able to help you calculate it and go through what the eligible expenditures are to find out if there are any other circumstances which may mean that even if you have a negative Z based on this form, you still don't have to pick it up as income. There are certain scholarships and grants, not many, just a very, very few, that are, even when they become a negative Z, as we see here, are still not taxable. Very, very few of those. Most of them can become negative Z and then yield to some taxable income. That's a big lesson. That's a big lesson on income from whatever source derived. All right, some tax planning as we get close to wrapping up the presentation portion. Some tax planning. If you're working, contribute to an individual retirement account. Specifically, the word on the street, or the smart word on the street, is do a Roth IRA. Now, the Roth IRA is debatable whether it's better than a regular IRA or not, but let's just talk about it for a minute, just to have a quick discussion about it. The regular IRA is deductible, and that means lower taxes in the year you put the money in. So that's cool. deductible, can lower your taxes. On the other hand, a regular IRA becomes taxable when you take the money out at retirement or earlier. It becomes taxable when you get the money. So that is the drawback. That's the good news and the bad news of a regular individual retirement account for retirement purposes in the current year when you're making the contribution into those accounts. And those accounts have to be specially done with a bank or financial institution labeled as such. They have to be the custodians. You can't just do this on your own. So you would go, like I said, to a bank or financial institution. Same thing with a Roth IRA. You're going to need the help of one of those kinds of banking institutions or money people in the money business. But a Roth IRA has the following. It's not deductible, and we would say boo, but it's not taxable when it's taken out. So it's not taxable when it's taken out. And that's the advantage of a Roth IRA. And like I said, the smart money on the street seems to be, oh, that's what you want to do. Do a Roth IRA so you don't have to pay tax when you take it out. So all the growth, think of it, all the compounding of interest or dividends over the years, if leaving it in there for 40 or 50 years before you take it out, all that, if that's got to get taxed when you take it out, well, that seems like a heavy hit. Whereas with the Roth, even though you don't get the deduction now, you wind up not having to pay tax when you take it out. What a relief that could be when that happens. In the time period that the Roth IRA and the regular IRA grows, while it's compounding, when it's growing, no taxes are paid on that growth. So that's why there's a lot of people claiming, oh, the Roth IRA is the place to go. I can make one little argument, and I won't spend a lot of time on it. I can make one little argument why maybe it's not so clear, and that is 40 years from now, when you go to take the money out, that's a long time. We don't know what taxes are going to be like. We don't know what the tax law is going to be like. We don't even know where you're going to be living. So I'm not so sure it's a slam dunk, but I will politely suggest that the Roth IRA seems to have the better route to it. Okay. Now, the amount you can put in for 2022, I think, is gone up a little bit. They raise it by inflation. Your bank and financial institution will know how much you can put in. It's going to be based on your earnings. You have to have at least $6,000 earnings to get to the maximum or the higher amount, whatever it might be in 2022. But this is what you can put in. And the good news about making this contribution, that's what we're going to call it, contribution to a retirement account, the IRA specifically, is that you have until April 18th of 2023 this year to contribute, because tax filing season doesn't end until I think April 18th this year again, just like last year. I think that's the way it works, or it might be April 15th. Check with your local CPA. I got to look it up. That's my answer to these kinds of details. But the neat thing is this is after the 2022 year. So you have many, many months to still make the contribution and to either get the money into this Roth IRA for the 2022 year, so it now starts to grow tax-free, or to put a regular IRA in and get the deduction on your 2022 tax return. And that's the planning tip that you need to know about. If you haven't heard about it, if you haven't thought about it, it's something to consider. Take a look at what your tax return looks like without it. Take a look at what your tax return looks like with it. And take a look at what your money you have sitting around that you feel you really should be investing for the long haul. If you have that kind of money and can afford to find it somewhere legally, it is a great idea. The longer you let money compound, the sooner you put the money away, the more you'll have at retirement. And this sort of says it all. The money grows without taxation coming out of it. You can start taking it out at age 59 and a half. You can wait until even whenever you need it if it's a Roth contribution. So it's the word for the wise. Take a good look at the IRA accounts. All right, this is more information, which Debbie will have on the slides where you can see more about it. Some of the advantages of what the Roth IRA allows you, which is you can take out $10,000 for your first home purchase. You can use it to pay for education expenses for you or your children. That's a nice thing. So even though it says age 59 and a half, if you need it sooner for these types of reasons, you can take it out without penalty, without tax, and use it. Even for having children or adopting children. So there's a lot of interesting reasons for the Roth being advantaged over the regular, because this is what the Roth allows without having to pay tax or penalty for these types of uses. Now, the Roth regular also has allowances where you can take money out earlier than age 59 and a half without penalty, but you still will pay tax. Okay, all right. Let's see. That's the same slide. Student loan interest we spoke about, that is potentially deductible, and the amount you can deduct would be up to $2,500. That's the total top amount you can deduct. More tax planning, open a 529 plan if you are soon starting a family. You have to wait till you have a family or adopted children or children of your own, but open a 529 plan for them. It's an educational plan. It's set up to pay for education in the future for a child, pay for education. Now you can use it for kindergarten, 12th grade, as well as college. It grows tax free. If it's used for these purposes, it also comes out tax free. It's just a great tax advantage vehicle. And so I encourage you that if we don't go through all the rules here, which we won't, keep in mind how a CPA today said, if you have children or if you have parents that are and you have siblings that are a lot younger than you, encourage the parents to put money into a 529 plan for those younger siblings. I also encourage you to e-file as soon as you can, electronically file. Electronically filing your return, if you do need to file, and most of you will, is advantageous in the filing. You'll get your refunds faster. You have proof that you filed. If you file sooner than later, you can beat anybody who might be trying to use your Social Security number for a fraudulent refund request. That won't stop you from getting your own refund, but it'll take a little longer because the IRS has to sift through the fact that your number was used for fraudulent purposes. You don't necessarily lose your identity if that happens. They're pretty good about how this all works today, but it's a pain in the neck nevertheless. So the sooner you electronically file, the better you will be in the long run. There's TurpTax. That's our website address. So you can take that down, make note of that. Feel free to email me directly. Debbie can give you that information upon request, and feel free to contact TurpTax for an appointment if you wish, or just to see me and ask me questions. Okay. Oh, one last thing. This is from last year, Debbie, but it is a good point. We talked about the IRA on the left-hand side, how an individual should do that, because most employers don't do IRA plans, but most employers have 401k plans or other types of retirement plans. They often will have what's called an employer match. An employer match means if you put in money to the 401k plan out of your paycheck, if you put in your own money or you defer some of your pay to put it into this retirement plan, the employer will also put in money. They'll match up to a certain amount. They'll match maybe dollar for dollar, maybe 50 cents on the dollar, but they'll match to some degree how much you put in. So it's sort of like saying, the employer saying to you, well, if you're going to save for your retirement, we'll help you. This is free money. That's why the face at the bottom with the green smiling face is, if you take advantage of the employer match, that's extra money. That's like a bonus. So when you go to work, if you're already working at maybe even your employer that's going to be your full-time employer, check with HR, the Human Resource Department, what benefits do they have? What are the tax advantages of those benefits? But specifically ask about their retirement plans and see what they've got. If you're with a nonprofit, it'll be a 403B plan. They may be doing the same thing. Don't leave that money on the table. That's just word for the wise. Okay, I will do the following. Let's see what happened here. I want to get rid of the sharing. So let's see. Oh, there we go. We're back to full screen here.
Okay. Are you ready for questions, Sam?
If I say no, is that not allowed? I have to say yes?
You have to say yes.
Okay. All right. Well, I'm all
All
set.
right, folks, go ahead and use the Q&A. We have been putting information in the chat in case you don't have that turned on. The questions go in the Q&A.
I can also look at the questions that came in
Okay.
ahead of time. Let's see what we got here. Someone launched a fundraising organization for an NGO. I assume that means non-government organization in another country. And the money comes directly to my account, which I transfer to the non-government organization using Western Union. Do I need to file taxes for this? So they're fundraising for a non-government organization in another country. So if the money comes in and goes right out, I think you're probably okay, because that wouldn't be income to you. You're moving it out. But why is the money coming in? Where is it? Oh, you're fundraising. Oh, that's an interesting question. Received grants and financial aid. Or let me do one question at a time. So if you're fundraising for someone else, I would say that if you're doing it in significant money, you probably want to set up a U.S. charitable organization so that it's clear that you're not raising the money for yourself. You can also, by setting up a U.S. charitable organization, you can offer the people you're fundraising from to get a tax deduction for the dollars they give to that organization. It's pretty easy today to set that up. The 1023-EZ to get a charitable organization established with the IRS and allow for tax deductible contributions by the donors, provided they're not using the standard deduction. But that's a pretty powerful way of making sure you do not get in trouble with the IRS someday based on what you're doing. Because the IRS might interpret your fundraising as services rendered for this non-government organization, and then the money going to this NGO in another country might not be considered deductible, and they could start making a little bit of trouble. I think most tax practitioners would say you should win the game at the end, but why play the game that way? Set up a charitable organization, just put the money in there. U.S. organization, easy to do. Okay.
We got a few questions in the Q&A chat, so I'll go through these.
Okay.
The first question is, I will be finishing my degree this summer in 2023. Although I am an F1 student, I am considered a resident alien for tax purposes. Do I need to keep filing federal and Maryland taxes after leaving the US? I think my substantial presence test will also apply to the 2023 and 24 tax.
So that's a great question. That was almost a question for last week, but it applies this week too. If you're going to meet that substantial presence test in any year that you do, and you have any US source income, you will have to file. Let me rephrase that. If you meet the substantial presence test, you will have to file as if you are a resident, which is that worldwide income from whatever source derived. So I would be careful about that, because you don't know if you're ever going to want to come back to the US. So as long as you're meeting that test, now in order to meet that test in 2023, that's already pretty easy because you've already been here 31 days. In 2024, if you're not here 31 days, the test doesn't apply. So the good news is, if you're leaving the US in 2023 and you don't plan on coming back for several years, then 2024 will be off the chart. You won't be meeting the substantial presence test, because you have to have at least 31 days in that year to even apply the test.
All right, next question. For the tuition form, are student fees included as tuition?
Student fees that you pay, if they're required to be paid in order to be a student, then they would be considered part of the eligible expenses that reduce the amount of scholarship that you get before any scholarship is taxable. I think that's the question. Those eligible expenses include tuition, fees that are required. Books, they are not. For graduate students, books don't qualify, but the required fees do. the rules are more lenient for the undergrads. So sorry, grad students.
All right. Next question. Does it matter if I am a PhD student when filing dependent or independent? I thought that PhD students were automatically independent.
So the answer to that question is they're not automatically independent, because if you're living at home and you don't have any source of support, or more than half your support from yourself, so somebody's supporting you more than half, and there's ways to figure that out. They're rather complicated, but let's say it is more than 50%, then you can be claimed as a dependent by the person supporting you. That person has the ability to put on their tax return, I'm not claiming you, in which case you are independent for tax purposes. That's a decision you need to discuss with the person who is supporting you, as where is the better tax benefit is probably the way you want to play the game.
Okay. Next question is, I have dependents who are US citizens. I will not make any income in the US or from any US employer, and my source of income will be from a foreign employer. Should I keep filing taxes after I leave the US? What are the pros? For example, the refundable child tax credit for each child, and cons of keeping filing state and federal taxes.
Okay, let me make sure I got one part of that. This person has 2 children that are US citizens.
Yes.
Okay, and we're going to assume that this person is not a US citizen and will be not a resident when they are not inside the United States. And when they're not inside the United States, they will not be eligible for the child credit. So for them to file for that would be meaningless, because it wouldn't apply for their children. An interesting twist to this, which could be somewhat of a little nightmare. I mean, having US citizen status is probably a good thing. A US passport still has value on the black market, as far as I understand. But for those children, they will remain a US citizen unless they positively and take steps to renounce that and get rid of that. They will remain a US citizen as long as they don't do anything to expatriate themselves. And they are required to file a tax return every year, even if they're not here. There is no presence test for them. They're citizens. They have to report tax on their worldwide income from whatever source derived every single year. So you probably should do them a favor by arranging to get those tax returns filed every year, even if they have little or no income, just to keep them up to date, because it will save them some major league headaches if and when they grow up and they want to come to the United States and they find out that, oops, I didn't file. There are procedures to take care of those situations, but they are not pleasant. They're not easy. Believe me, you will be doing them a great favor if you want to keep their US citizen status by filing those tax returns, even if 0.
Okay. Next question is, if I moved to Maryland and lived here for less than 6 months in 2022, do I have to pay taxes in Maryland? Also, do I have to pay county taxes? How much should I be withdrawing for taxes if I have a stipend, not a graduate assistantship?
Okay, let's answer the last part first. Stipend, fellowship, scholarship, all those words mean the same thing under the US tax code. The tax code doesn't care what you call it. So anything that is helping you for your education, your research, your whatever it's for, writing a book, for example, whatever that's for, that's all considered one and the same. To the extent that any of that gets used for tuition or the required fees, that's not taxable. But to the extent that it covers more than that, as we went through, that's a taxable event, and that needs to be reported. Now, the first part of the question, remind me again, was the states. So it's very interesting. The state of Maryland, the person mentioned 6 months, and the reason they mentioned that is because you're not, quote, a tax resident of Maryland, or most states follow the same rule. You're not a tax resident of most states unless you're there 183 days in the calendar year. So it's more than 182. California just I don't know why I'm remembering this, is 9 months. But most states it's 183 days. Once you're there 183 days, you're a resident for tax purposes, which means all of your income for the year has to be reported on that return. So if you're less than 183, what do? Well, then you have to say, did you have any Maryland income? Because if you did, you have to file that as either non-resident Maryland income and show it on a non-resident Maryland return and pay the state tax, including the local tax, or maybe you are now a resident, part-year resident, because if you moved here, let's say you moved here in October of 2022, you moved in October. So you're here in October, but you made it, you're less than 183 days, but you made the move here. Your intention was, I'm now going to live in Maryland and I intend to live in Maryland. That's what we call domiciliary. It means you're a resident of Maryland from October 1. So you'd file a part-year resident return showing your income from October 1 on the rest of the year. Not the whole year because you weren't a resident the rest of the year. Then you presumably have to file a return for wherever you came from because you left that state. You're probably there, you might have been there 183 days or more, meaning you are a resident there and you have to file as a resident. There you get to file as a part-year resident as well because you left, but you still have to file there because you were there for 183 days. And if you had any income there, you still want to file for that too. Gets complicated multi-states.
Absolutely. The next question is, I am receiving a National Science Foundation funded research stipend for the calendar year. Taxes are not being withheld. Do I need to pay estimated quarterly taxes? Are there penalties if I don't pay the taxes quarterly?
Wow, that's a great question. I don't believe the NSF is that one little carve out of scholarships that are not taxable. Something in my mind says I would want to look that up, which I don't have the freedom at this particular moment to do, but I would be checking that. If it's taxable, then in theory, you may have needed to pay quarterly taxes, or you may need to pay quarterly taxes this year. It all depends on the safe harbor rules for estimated taxes. Quarterly payments are considered estimated taxes. When you work for an employer, they withhold, so you're automatically having your taxes paid as you go. Let's back up a second, just for the purpose of education. The United States lives on a pay-as-you-go system. It's they don't want to wait till the end of the year and then you figure it out and then you say, oh, well, I don't have that money, so screw the IRS. They want to take your money as you go, pay as you go. When you work for an employer, it's easy because the employer does it for you. When you are getting a stipend that might be taxable, or you're working as an independent contractor where there's potentially taxes going to be due, then no one's withholding that. And then you have to make these quarterly estimated payments yourself during the course of the year in order to avoid penalty. So yeah, you could, if you don't make the payments, you don't pay as you go properly, you could be subject to penalty. In this particular case, my guess would be that, for example, there's a safe harbor that if say in 2020, let's say we're talking about 2023, that's the concern, let's say, and in 2022, you had no tax liability, you're at zero taxes, then you don't have to do anything for 2023. It's only after that year that you're going to need to worry about estimated taxes. There's 3 or 4 different state safe harbor provisions on when you need to make those payments. I guess the bottom line is you're going to need some tax advice. You're going to need to seek out somebody to help you figure out whether you need to do that. There's also a limitation. If it's too low, if it's the minimus, then you don't need to do it. And I'm scaring myself into this person checking with me. Okay.
All right.
But the point of that question is good for everybody to know is that you do have to pay as you go. So if you're an independent contractor, or if you have a large enough stipend or fellowship, it's a question to raise.
Okay. All right. So that was the last question in the Q&A.
Okay.
You did answer one from the list, the one about the NGO and stuff. Did you want to just go through those yourself, or you want?
Right. We've actually answered 2 of them. The first one you just read was the same one, the same question.
Oh, I see that. It is.
But it was a question that said ways to reduce taxes. Ways to reduce taxes.
Right,
So
and to add on to that, excuse me, Sam, I think that it's ways to reduce taxes. This is for someone who has 2 sources of income, but they don't understand claiming deductions.
Okay. So if they're a resident, citizen or resident, everybody gets a standard deduction. That's a pretty hefty amount today, thanks to the 2017 Tax Reform Act that occurred. So it's a pretty large amount. In the event that you have, you meet the follow, well, let me do it this way. That our tax code tends to have socioeconomic results, for better or for worse. It's sort of Congress's idea of how should we help people lower their taxes? What types of people should we help lower their taxes? So there's a couple that would be appropriate to mention to, say, someone who's graduating this year. And that is that in the event that you want to reduce taxes more than what the standard deduction allows you to reduce your taxes by, then you're going to want to buy a house because home mortgage interest is deductible. Real estate taxes are deductible up to a limit. You're going to want to give money to charities because that's deductible. And you're going to want to have lots of children because children create child credit and that's deductible. So go figure what Congress had in mind, but appropriate the world and buy a home.
We had a follow-up question about the quarterly estimated taxes. How do we pay as we go is the question.
Okay, so then you need to go to the IRS website and look for quarterly estimated vouchers. I think it can be done online. It's a little bit of a procedure, but you can pay online. You pay April 15th, June 15th, September 15th, and January 15th. Let me say that again, but you can find it online with the irs.gov. The 4 quarters are not the normal calendar quarters. It's April 15th, June 15th, September 15th, and January 15th of the following year. And so that's basic. You can also mail them in if you want, but online is the preferred method.
All right.
I just want to interject, Sam, I want to let you know it's 1:27. Do you have another appointment that you need to get to, or would you mind staying on a little bit to answer more questions?
I can stay for about 3 or 4 minutes because I do have a 2 o'clock class.
I understand. Thank you.
Try a couple more. Let's see. We had the one with the South African. My wife got married in July. Congratulations. She's South African and still lives there. How do I include her on my tax return? I moved to from South Africa to Maryland at the end of July 2022. And before I lived in South Africa, I lived in California. So I paid 2021 taxes there. So now that you're in Maryland, you're going to pay Maryland taxes. I answer that first. And if you are a resident for US tax purposes, you can declare your spouse and get yourself into a joint tax return and reduce your taxes that way, but you'll need to get a ITIN number for her if she doesn't already have that, or a social security number, which she probably doesn't. So you may need to consult TurboTax to get a little bit more information on all that. TurboTax, okay. Using a tax filing TurboTax. They're not bad. You might, if you are a resident, you can use TurboTax. If you're not a resident, you can't use them at all. So you have to use a different service or TurboTax. But I wouldn't necessarily say, if your income's rather low, I wouldn't necessarily say don't use it. I have some people who come to me who use TurboTax to prepare their return. They want me to look at it. I take a quick look, either bless it or tell them what they missed. And you can do that with TurboTax as well. You don't have to come to us for a full preparation. You can ask questions.
All right, Sam, there's a follow-up question. And it's, you said that I should file a tax return for a US citizen child. When should I start? For example, when the child becomes 18 years old?
So you probably want to consider starting a lot earlier than that if they have any income from wherever, again, whatever source, if they have any income. If they have bank accounts in other countries in their name, you need to consult a CPA to see if you need to file an annual return for them. just declaring what's in the bank. If they have investments, you may need to do the same thing. So the US is very interested in their citizens, particularly if they have assets abroad and or living abroad. They want to make sure that they are paying their share. One theory for this is that those US citizens can go to any US embassy and request services. That they have that right. So for that right, the US government expects you to toe the line and pay whatever taxes are needed, and they can be from anywhere in the world. The income can be from anywhere. So I would suggest early on having a US or someone who is well versed in US tax law for citizens of the United States understand your situation and the situation of these children. And we'll make that the last one, I think.
Yes, I want to be respectful of your time. So,
Okay.
Sam, always great to talk with you about taxes. You make it interesting. You are just such a great wealth of information. I particularly appreciate you showing the tax forms. It just, it helps us all understand things a little better. So thank you so much for sharing your time and your wealth of information with us.
For those participants, thank you very much for that. And for those who are still on the line, just or watching, just a quick caveat. The tax code is very complicated for citizens. It's more than 10,000 pages long. There's a lot of regulations that apply. If I didn't hit an answer to your particular question, or if I sort of dodged your question, I apologize, but it's within the interest of time, and certainly have the ability to address any individual student of the University of Maryland or graduate of the University of Maryland through TurpTax. Just contact me direct. For free.
Perfect.
For free.
For
Okay.
free. We love free.
Yeah. Thank you very much for having me here. Okay.
Well, thanks to everyone who joined us today on Zoom and on YouTube. It was good for us to spend some time together. So come back next Tuesday for a workshop on job contracts. You gotta get this information before you sign anything. So we hope to see you on Zoom next Tuesday. And please remember to fill out that post-workshop survey because we need your feedback. So have a good week, everyone. And as always, let us know how legal aid can help you. Bye.
Take care. Thank you.